The average savings account in the United States pays 0.58% interest. The official inflation rate over the last year was 3.4%. This is not a savings account. It is a managed decline of your purchasing power. You are being charged 2.82% per year for the illusion of safety. This is a mechanism called the liquidity drag. It is the invisible friction applied to all cash held in the banking system. It was not designed to punish you. It was designed to compel you to move your capital into other assets. Assets you have to buy from the same system. Over $17 trillion is currently held in U.S. commercial bank deposits. Much of this capital moved there after the 2008 financial crisis. People sought safety from market volatility. They found a different kind of trap, a slow, silent erosion that functions like a tax on inaction. This system does not need a market crash to take your value. It just needs time. Let's analyze the first layer of the mechanism. Imagine you have $10,000 in a high-yield account earning 4.5%. After 1 year, your balance is $10,450. This is what we call the nominal gain illusion. You see more dollars. You feel wealthier. If inflation was 3.5% that year, your purchasing power only grew by 1%. Your $10,450 now buys what $10,100 bought a year ago. The bank advertises the 4.5%. The system quietly takes the 3.5%. The second layer is more fundamental. The Federal Reserve has an explicit inflation target of 2%. This is a public policy of currency devaluation. The stability of the system depends on your money being worth less next year. This incentivizes spending and investing. It discourages hoarding cash, which would stall the economy. Your personal savings are secondary to this systemic mandate. This is a form of targeted devaluation. This drag compounds with absolute certainty. Take that same $10,000. Assume it earns 2% annually for 20 years. Assume inflation averages the historical rate of 3.8%. After 20 years, your account balance will show $14,859. The purchasing power of that money will be just $6,920 in today's dollars. You followed the rules. You saved diligently. You lost 30% of your wealth. The official term for this is financial repression. It is a documented set of policies used by governments. It channels funds to themselves that would otherwise go elsewhere. Low interest rates combined with inflation is the primary tool. It allows massive government debts to be paid back with devalued currency. Your savings account is helping to subsidize this process. Capital Dispatch reconstructed this analysis from public financial records, economic research, and documented market data. The escape is not a secret. It is a procedure. We call it the Asset Conversion Protocol. Step 1 is to re-engineer your safety net. Your emergency fund is a tool, not a hoard. Hold 1 month of expenses in liquid cash for immediate access. Place the next 2 to 3 months in short-term government treasury bills. T-bills often yield rates that track inflation more closely. This minimizes the drag on your foundational capital. Anything beyond that is surplus. It must be deployed. Step 2 is to build an inflation lever. Leverage means acquiring assets that outpace currency devaluation. This is not about picking stocks. It is about owning systems. Broad market index funds have a documented historical return of 10%. Income-producing real estate creates cash flow that can adjust for inflation. You are building a structure that produces value independent of your idle cash. It must work while the currency is being debased. Step 3 is to automate the conversion. Every surplus dollar from your income must be converted. Set up automatic transfers from your checking account to your investment positions. The goal is to minimize the time your capital sits idle. Idle cash is a depreciating asset. Its only function is to be converted into an appreciating asset. This is the mechanical process of escaping the liquidity drag. The system does not punish the uninformed. It simply charges them for their liquidity. The price is the slow, silent theft of their time and energy. You were told your savings were safe. You were not told what they were safe from. Capital Dispatch. Now you know the math.